Hello from Otis Markets. This is Ahura, and I will be here with you to have a short review on European Central Bank meeting and market reaction. First, let's check what we had as it decisions and data, and then we can see the market reaction to these data as well. At the beginning of the month, when we were looking forward to the October, the most market analysts and most financial market analysts, they were thinking that most probably European Central Bank will hold the current rate in this month and will cut again in next month after August rate cut that we had. But later in the month, when we started October, in the last 2 weeks, we had several economic data, including today's inflation numbers. As you see here, inflation in September fell to 1.7%, much deeper than what we were expecting at the beginning of the month. At the beginning, we were thinking that maximum is going to be around 1.8 and 2%. But now we can see the annual inflation down at 1.7%. That's while we have the other economic data such as economic activities, PMI numbers, GDP, and other economic activities and data that they are showing weaker than expected economic growth. So we have low inflation, even thought it's lower than central bank target, less than 2%. And at the same time, we have weaker than expected economic growth. So these data means that the central bank should not be so much worried, should still be worried, but should not be so much worried about the inflation fade. And now must look and turn its look to the economic activity, to the labor market, which lately showing some weakness signs. So now the central bank should turn its look towards labor markets, towards economic activities, and focus more on this the area. So that's why we can see that the central bank in Europe, they cut the rate by 25 basis points down to 3.25 basis point, 25% for the deposit facilities. At the same time, they had it more dovish outlook for forwards and so, but still, while the bank they didn't have any they didn't give us any idea that what's going to happen in next meetings, but still with the tone that we had in the statement, now we can expect that the central bank at least will have one more cut, at least one more cut here in 2024. This is what we can expect. So it's some more dovish than what we could expect at the beginning of the month. That means before going to check the charts, let me say that at the same time, like with 10 minutes difference, we had the labor data from the United States as well. We can see the initial jobless claims fell to 240K, down from 260K registered in the week before that, and continuing jobless claims increased to 1,867,000, but still it's less than market expectation. Generally, the data shows that the labor market is still resilient and strong. This is while the economic activity, Philadelphia Fed Manufacturing Index increased to 10.3, and retail sales increased by 0.4% in September. These data means that the economy in the United States is fine. Still is fine. So let's go on now and check the charts and see how the market reacted to these charts. Let's say Euro USD chart, as you know, lower rates. It means that the central bank and the banks generally, they can give more loans. Actually, the consumers, the businesses, they can get more loans with lower rates. More loans means more cash in the market. At the same time, which is the negative for the currency. At the same time, lower rate means that the attracting the investment, foreign investment will be lower, which is the negative point for the economy. So again, negative for the currency as well. So again, there's a negative signal which they just put more pressure on euro against its rivals, especially against US dollar. So euro USD, especially under 1.088, which it was pointed at the beginning of the week, will still under this level, will still continue its downtrend. So our outlook for the euro USD is still bearish and negative. At the same time, this decision can support the stock market, European stock market. can take advantage of that. Lower rates means that the businesses, companies, they can have more cash or they can have more investments, which it means positive, which can be the positive for the stock market. That's why you can see that Euro 50 took advantage, can take advantage of that and still and continue its slight bullish. I can say slight bullish bull run because if you look at the little bit bigger picture, you can say that you can see that before its fall 2 days before Monday's fall, Euro US before Tuesday's fall actually, Euro 50 was continuing its slight uptrend, which is still possible to see to forward that the Euro 50 and other European stock market can continue that further, and we can see the positive reaction in the stock market. So lower rates, more cash for the companies, which is positive for the stock markets. More cash in the currency market is the negative for the currency. So Euro USD's downtrend can continue, and the stock market is positive. This is what we had as decisions and the data and market reaction. Hope it was useful. If you had any other question, do not hesitate to write down in the comment section. I will try to get back to you as soon as I can. Have a good time. Bye-bye.